Morning. Thank you all for joining us for today's coffee talk. My name's Sean O'Brien, former president of Quick Rate, and as always, I'm pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks again, everyone, for joining us for our next installment of the CECL Coffee Talk. My name is Steve Huntington. I'm the Director of Analytics here at Optima FI. I've spent my entire career working with community banks in all manners of analysis, including strategic planning, valuation, M&A, capital planning, and I spent more than half of my career here with Quick Rate and Quick Analytics, now Optima FI and Call Report Insights.
Awesome. And also pleased to be joined today by Bill Rogala. Bill is the lead product manager for Optima FI. Bill, you want to go ahead and introduce yourself?
Sure. Thanks, Sean. Thanks, Steve, for having me. Bill Rogala, lead product manager here. I've been in business-to-business SaaS product leadership across financial services and automotive companies for the last 15 years. I'm leading the Household Insights product strategy. I'm going to show that off at the end of today's coffee talk. Graduate of Northern Illinois University and a competitive long-distance runner. And when I say competitive, I mean I've done some races, not that I'm actually very fast.
You're
Awesome.
come on, be honest, Bill.
Exactly.
Yeah.
If you're a long distance runner, you're by nature, by definition, competitive.
Competitive, yes. I wouldn't say that I'm a fast long distance runner where I see people doing like qualifying for Boston marathons. Like I'll never be that fast. Like 4.5 hour marathon or like did a just over 6 hour 50K, but that's the best you're going to get
Awesome.
out of
I'm a huge proponent of the run walk method.
me. Yes, for
Mostly
sure.
walk, little jogging here and there.
For sure.
Well, thanks everybody for joining us again today. Just a reminder, we're here just to kind of go through some current certainly any questions you have regarding CECL. Again, just share some information that Steve compiles, and then as Bill indicated, he'll share some information about Household Insights, a new offering here at Optima FI. Steve, if you if you want to just start again, talking a little bit about any of the updates and the enhancements. Oops, I
Yeah,
missed some slides here. Hold on.
I think we skipped some slides here.
Yeah, they're gone. My thing is going from 4 to 8. Not sure my deck.
Yeah, see if you can get to 5.
No, I got. Hold on.
We need the technical difficulties elevator music.
Well, I think this. Let's see here.
Do you have the updated deck, Sean, or you want me to share mine?
Again, I think I thought I had the updated deck showing, but let's see.
Steve, you can do the elevator music.
Thanks. Thanks, Jen. Way to throw me under the bus there.
Okay, here we go. There we go. Here we come. All right. Let me get this. It's still doing it. Why is it cutting those slides off for me?
Jen, you want to share?
Yeah. But anyway, you can do it from this on the slideshow. These are not showing, but let me just put this up here.
Here we go. Jen's sharing hers. Oh,
Here we go.
All right, are y'all seeing my slide deck?
Why don't Sean, why don't you unshare and just have Jen share hers? Yeah, I'm seeing yours now, Jen, and just head forward to slide 5.
Just did the same thing. And I can show it, but it's not going to be in the slideshow. So
You can just head to the slides instead of a slideshow, Jen.
do that because
Or Sean. Yeah, just
I'll
okay.
do that.
We're all friends here.
All right, Sean, you've got it.
Yeah.
They were chosen to be hidden for some reason from the presentation, but they're still in the deck.
Yeah. So here we go, Steve. For the next these 3, we'll go into slideshow after this.
Yeah. So just 6, 7, and yeah.
Yep. So again, Optima FI is a combination of Quick Rate, IntelliCredit, and Infusion marketing services. Again, been serving community banks for over 40 years in a number of different ways, all brought together under the newly formed Optima FI. Steve or Bill, anything you want to add here before I move on?
Nope.
I'm looking good.
More specifically, whoops, here we go. We've kind of defined or divided up the solutions into three different areas: Optima FI growth, Optima FI credit risk, and Optima FI balance sheet. Again, you can see the old CD marketplace under the balance sheet solutions along with call report insights. And Bill's going to discuss household insights later on in the presentation. Again, Steve, anything you want to add here, or Bill?
Nope.
Okay.
All right. Yeah, I think you can share your presentation.
Yep.
Now again, Sean.
Okay, so here we go. I'm not sure where, yeah. Okay, so again, just to cover a few things here, questions around CECL. Steve's going to start with the updates. Steve, take it away.
Yeah. In the recent past, we have updated the Fed stress testing scenarios for 2026. Those come out in February of every year. I believe we kind of briefly showed you guys on the last coffee talk, but in the knowledge base section of the CECL Solver tool, there's a big button for the Fed stress testing scenarios. And again, it's a handful of economic trends that the Fed puts together, gets a bunch of economists in a room, and gets quarterly projections going forward 3 years, and they're perfectly apples to apples with a quarterly historical trends going back 20 years. So it's really great for helping out with economic or external qualitative factor adjustments, so you can see and kind of track those economic trends historically, average projection or actual projections going forward 3 years, and then also a stress scenario or a severely adverse scenario, which is, again, not a projection, really just a hypothetical Armageddon-y type scenario, which shows each of those trends at a baseline and in an adverse scenario. So it's really great economic data that helps with qualitative factors, and we make sure we update that on an annual basis. Couple quarters ago, we added the simplified version of the unfunded commitment methodology. We tried to just make it even more straightforward and conceptually, so your auditors and examiners spend less time focusing on how we're doing the math and more time on recognizing what a relatively small piece of the puzzle the unfunded commitment section is from a CECL perspective. And we have we continue to add different modules and tools to the industry trends platform, one of which I'm going to show you guys today. That's that last bulletin right there. Additional tools, what we call the peer group performance matrix. So if you head to the next slide. Okay, that's just a reminder of what those, forgot to add this in the deck. Reminder of what those economic trends look like, right? There's about 13 or so of them going back in time and forward in time on a quarterly basis. And it's a great apples to apples way to compare that data. Yeah, next slide. So this is the new peer group performance matrix. It lives within the industry research section of our website. The idea here is that you can build, customize your own personal sort of dashboard to benchmark peer group KPIs from worst to first. So from the 10th percentile, so you get to handpick sort of what metrics you want to see. You pick a point in time, a quarter, a year, a trailing 12 months, and you choose a peer group, and you choose all the metrics that you're looking for, and it'll give you each decile, right? From the 10th percentile all the way up to the 90th percentile. And because some metrics are better higher, and some metrics like ROA, some metrics are better lower, like net charge-offs, we highlight in red when a 10th percentile is bad, and green when a 10th percentile is good, and vice versa on the other end of the spectrum. So it really gives you a pretty good idea. Like on one piece of paper, you can see not just peer medians, because they can be misleading depending upon the trend and the metric and the time period. Getting to see the entire broad spectrum of, if you're looking at, core operating earnings, whereas the median for community banks around the country is about 1.5%. The 10th percentile is 49 basis points. The 90th percentile is 2.39%. And again, we default to what we call kind of an executive package, which is just highlights from each different area of performance: balance sheet, income statement, loans, deposits, yields, etc. But we also allow you to completely customize that. And so you can expand those categories on the left and just check off the boxes of the metrics you want, or you can search for each metric in the box right there. It has no limitations on what you can search for. So pretty much any ratio that we have in our entire database, which there are a few hundred of them at least, you can choose, and you can add as many as you'd like to this report. I think I gave a great example of how it can be helpful, particularly from CECL, on the next slide. Hopefully, yes, it got in there. So I just customized, I customized it just by choosing, what if I just wanted to look at 30 to 89 days past due for each different section, different category of loans. And I didn't go too granular. I did, total 1 to 4 family, total non-farm, non-residential, as opposed to getting, splitting it up into the subcomponents and just seeing kind of from worst to first, so to speak. So you can see, while the median 30 to 89 days for total construction and land development is 0, so that's not really very helpful, right? At any given point in time, more than half the banks in the peer group have 0 net for that particular metric. However, to get a feel for how banks are performing there, beyond just the median, you pull this up, you look at all the deciles, and you can see that, 80th and 90th percentiles start to accelerate and deteriorate pretty rapidly. So while the median is 0, 20% of banks, right, the 80th percentile is 38 basis points. That means that 20% of the community banks in the country have more than 38 basis points in 30 to 89 days past due for construction and land development. So this is just getting you beyond what some of the base median sort of metrics are, to see a spectrum, which can be a lot more helpful, especially when you're looking at granular data and data that for at any given point in time, if 52% of the banks are 0, then the median is going to be 0. And that's not helpful at all to see trends over time and really compare yourself across the spectrum. So that's the new peer group performance matrix in industry research.
And I think, again, as we've talked before, as Steve kind of pointed out, just being able to see a little bit earlier, where things are deteriorating. I think as you think about your Q factors, when sometimes things feel like things are getting worse, but it's not showing up in the numbers, this kind of spectrum can kind of give you some insight that, potentially there is, something brewing, or maybe something to monitor.
And we had a question pop up, any ETA on the tool looking for peer losses based on different percentiles? Yeah, so that's an enhancement that we've been working on for a while. We hit some data and some modeling snags that's caused that to kind of drag on for longer than we had anticipated. We had kind of planned for it to go live a few months ago, and that hasn't happened yet. We're still working on it, so I don't have an exact date for anybody yet, but that is still in our short-term roadmap, and we will be getting that out there to everyone. We apologize for the delay. I know how that can be particularly helpful, again, when looking at Q factors, not just looking at medians, but as you mentioned there, looking at higher percentiles, right? 50th, 75th, 90th percentiles, so you can see some of those trends beyond the median. All right, so I don't know how many of you have noticed. I'm sure some of you have noticed, but the FFIEC has decided to go ahead and consolidate a bunch of peer groups. So just when you thought the UBPR peer groups were somewhat sacrosanct and wouldn't be changing on us, nothing is forever, I guess. And so we had some changes. If you remember, a few years back, they renamed peer group 3 to peer group 5 and did some little shifting on us there. But that wasn't quite as meaningful as this. This peer group change is pretty significant for all the people on the phone right now who are under $300 million in assets. Your peer group is no longer looks anything like what it did up in before the first quarter. And so what I mean by that is, for all banks 100 to $300 million in assets, there used to be, excluding savings banks and de novo banks and bankers banks, for example, There were 4 peer groups, depending upon how many branches you had and whether you were in a more rural or more urban environment, so in an MSA or not in an MSA. You can see right there in the blue how many institutions were in each of those. So there were 229, 391, 220. So there was still a pretty decent number of institutions in each of those 4 UBPR peer groups, 6, 7, 8, and 9. But in their infinite wisdom, they've decided that those should be consolidated into one peer group, just like peer group 5 is all the banks 300 million to $1 billion. So there's 1,200 banks in there plus. The now everyone from 100 to 300 million is in a gigantic peer group of 1,142 institutions plus or minus. The challenge that's going to present for most of us that are in one of those is that if you are using your UBPR peer group for historical trends, and now you're in a quote new peer group that's much larger, they've gone back and retroactively changed all the historical data from those old peer groups too, so that now if you pull up peer group 6 and you look at data going back 5 years, it's consistent, right? It's all banks 100 to 300. So that's kind of what they needed to do. They couldn't not retroactively do it. However, the challenge there is there's no way on the UBPR or FFIEC's site to kind of recreate your old peer group. And if you liked the 100 to 300 million with more than 3 branches in an MSA, there's really no way to rebuild that on the FFIEC site as if the change consolidation didn't happen. So that's something that we're building into our platform right now. We're working on recreating the legacy UBPR peer group so that I hate to use an Obamacare quote, but if you like your old UBPR peer group, we're working on a way for you to keep your old UBPR peer group. It's a little bit challenging because of the way that they defined MSAs, the way that they defined average assets and everything else, but we're getting there. But as it is now, you'll notice if you saved a CECL solver scenario or a stress testing scenario on our platform, you'll notice that the peer data is going to look very different if you for your UBPR peer group 6. And there's nothing we can really do about that because it was a regulatory change. If you are curious as to where that decision came from, I was. It's the FFIEC's, it sounds very official, the Task Force on Surveillance Systems, the TFSS, determined that asset size is the real factor there and not rural or urban and branch count. So that's kind of just letting everyone know as a public service announcement that has happened. And we're working on allowing you to retroactively rebuild your old one if you really liked it. I wasn't necessarily a huge fan of the way that they split out 6, 7, 8, and 9 or 10, 11, 12, and 13 in the past, but it was consistent. And now we have a inconsistency going on. And so that's where the challenge is not in whether it's better or worse, but in the fact that something has changed that is significant when you're looking at long-term asset quality, particularly type trends. Sean, any thoughts on that?
I would say that I guess I do have a comment. I mean, I think the more stark thing is just the noticing the number of 50 to 100 million dollar banks at 357 and 159 under 50 million banks, right? So I mean, clearly we're losing those smaller banks. Still a good number between 100 and 300 million, but I was somewhat. I don't know if the surprise is the right word, but it really does kind of stratify, where bank sizes are currently. Because
and whether it's consolidated. Oh, go ahead, Sean. Sorry.
Well, I was going to say those most of my guess, right, is most of those 516, 100 million and under, right, they're not in in very large MSAs, right, and so they are all kind of unique to themselves. But nevertheless, I think I was just a little surprised by those
I was a little
numbers.
unsettled by just looking at the numbers and thinking back to 10 or 15 years ago and how those have changed, because we're looking at a similar institution list and the institutions are growing, and they're growing from the 50 to 100 to 200 to 500 million dollars in assets. What we're not seeing that would have a huge effect on this is, well, there's been less M&A, and there's been very much less de novos, right? And of course, those things work hand in hand. As institutions get acquired, as community banks get acquired, organizing groups come back and start more de novos. And so when one side of that slows down, the other side slows down because they work in tandem. And so you're seeing less new institutions in that under $50 million range be organized, and you're seeing less institutions at the top end of the community bank range being pulled out through acquisition. Not saying that industry consolidation is not still happening; it certainly is. But the pace of mergers and acquisitions over the last few years, compared to the 2000s, right, is certainly less. And the pace of de novo formation is a small fraction. We've never seen it come back in any meaningful way since the moratorium on de novo applications during after the credit cycle, or during the last credit cycle.
To follow that up, you just won't see de novos if you're not in that $100 to $300 million range, right? There's no chance of a de novo being approved if you're not going to have at a minimum, I think 10, 15, more likely 30 million of capital, right? You're just not going
Yeah,
to.
the average capital for a new formation, although the statistics are skewed by the very small number of them, of course. But you would see that back in the 90s it was $5 to $10 million,
For sure,
and
for
now it's
sure.
triple that.
Yeah, for sure, for sure. All right. So moving on to industry credit trends. Again, just some looks at some of the information that Steve compiles for all of us every quarter. Steve, go ahead and take it away.
Yeah, I mean, everyone's been, we've been hearing for years now, right? That we were expecting to see, deterioration in asset quality, and expecting a new credit cycle to emerge. And I would say COVID threw a wrench in that for a significant period of time. But since then we have seen continuing deterioration, but it's modest, right? And of course, we're looking at publicly available data here, right? If you can, when you're looking at private data, then you're looking at risk grade migrations and internal stuff before it ever really hits the call reports. We are seeing even some more deterioration there. But when it comes to the first time asset quality issues show up on a call report, it's what, 30 to 89 days past due. And so we have seen, you'll notice the red dots on those little spark lines, I guess they call them, the trend lines on the right hand side. Most of those red dots are last quarter, or the end of the year. There's a little bit of kitchen sinkiness goes on sometimes at the end of the year, or the first quarter of this year. So we're seeing, median. We showed median and 75th percentile here, particularly for those loan types that just don't see much at the median level, like construction and land development is 0 at the median level, but we're starting to see some numbers at the 75th percentile. Same thing with non-farm, non-residential. Even the median has come up from 0 to a handful of basis points. At the 75th percentile, it's come up to 66. So you saw a significant increase in past due loans at the 75th percentile for this is UBPR peer group 5. So I might just say half the community banks in the country, or close to it. We've also seen a pretty decent jump in C&I over the last quarter or so, but we had seen that early at the end of 2024 too. So I wouldn't say it's a consistent trend upwards. It's there's a little bit of seasonality going on here, but the trend is still generally up, still generally towards some slight deterioration, somewhat across the board in past due loans. Next
And I
slide.
think,
Go
yep.
ahead.
And I think just to add, yeah, again, I think consistent with the earlier slide, right? We are seeing some moderate deterioration. And I think for most banks, I think, I know locally I'm involved with a bank, right? We see, past dues up. People feel good about their collateral. I think the area that, I think we're certainly digging into for the ones that we do foresee some issues is just the workout, right? They take a long time. They cost a lot of money. And so as you think about your reserves and, the loans you're reviewing, take into account not only that collateral, but those associated costs that you might incur if you do have to, foreclose or, work out a lot of these loans.
Absolutely. And then we like to follow these through the timeline, right? The migration, at least from a call report standpoint. We don't focus on 90 days plus and still accruing. That is a category that a lot of institutions kind of started skipping and going directly to non-accrual from past from 30 to 89 days past due. So the statistics on the number of loans that get put in the 90 plus days and still accruing is different than it was 10 or 20 years ago. So we kind of skip right to non-accrual. And what we see there is clear, consistent increases in non-accrual loans somewhat across the board, right? Consumer loans at the median level, it's still zero. But when we look at the 75th percentile, we can see some increase. Where we see, when we're looking at C&I, I'm looking at you, C&I, right? The median is only, 12 basis points, but the 75th percentile is 95. That means 25% of you out there are approaching 1% non-accruals on C&I. And non-farm, non-residential is relatively similar. And 1 to 4 family is at the median level higher, 17, 18 basis points, but at the 75th percentile. So, the range is not quite as, there's not quite as broad of a spectrum of non-accruals for 1 to 4 family residential. So that's it's also some interesting and helpful information, not just to look at the trend, the median trend and the 70th percentile, but looking at the gap between the 50th and the 75th percentile to see how well, not how well, poor choice of words, how distributed the losses and past due loans and non-accruals are, whether everyone is within a tight range or whether it's all across the board. And I say there's definitely a tighter range for 1 to 4 family residential, which is not really surprising conceptually, and it's much more all across the board in owner occupied and other non-farm, non-residential, CRE type lending. John?
No, nothing more to add there. So we'll move on, just to some user database trends. Again, this is something that Steve works hard on, utilizing the data from Call Report Insights to put together. So, Steve, you want to go ahead and just
these numbers keep on creeping up, which is good for us and good for you because we turn that data around, right? With the number of institutions that we have utilizing the CECL Solver tool and the geographic breadth and the size, depth and breadth that we have in our database means that when we share that kind of those user trends, the blind pool sort of user trends with you guys and turn that back around, it becomes an asset, not just for us, but it's an asset for you because it's a lot of very helpful, completely proprietary, non-public data that you simply can't get anywhere else. Looking at, tracking your WARMs by loan segment and wanting to be able to compare that to some sort of industry standard. Looking at your Q factor adjustments, seeing what direction they've been headed in, up or down, and whether that's in line with your peers. And the same thing, total reserve levels, right? Your pooled loans, stripping out the individually assessed ones, just looking at the trends on your pooled loans by segment and getting a feel for whether your reserves are within that kind of that range of 25th to 75th or where you're an outlier. And those can not only spark healthy conversations internally and at the board level, but they can answer questions in an exam or an audit that can get them off your back when you have that sort of deep, detailed, granular industry data to provide a frame within, that your numbers lie within. So if you head to the next slide, I mean, you guys have seen this. It's updated with, all the first quarter numbers here. You can click on WARMs or Q factors or pooled reserve levels, and you can see for each segment, and you can look at 25th, 50th, or 75th percentiles and get the chart on the right there is just, C&I loans. So reserve levels on pooled C&I loans, a median, which is the light blue, the Carolina blue, if you will, hasn't changed very much. And neither is the 25th percentile, but look at that 75th percentile of reserves on C&I. That's come up. And is that surprising? No, after what we just saw with past dues and non-accruals, I wouldn't say spiking, but seeing meaningful increases in the last, particularly in the first quarter, seeing that same 75th percentile reserve level has started to come up too, is what we would in lockstep is exactly what we would expect. And you can see that data here reflected in this proprietary internal data. And the last slide I've got for everyone is more of the same. So this is just a summary of that over time, where you can see all of it on one piece of paper, right? 5 quarter trends in warms, Q factors, and collectively assessed reserves by segment, with some spark lines and everything there. Just a really great, helpful resource to compare your data to your trends, to sanity check where you're at in some of your calculations, and to provide ammunition in an exam or an audit for Q factors.
Great. All right. Okay. So at this point, we're going to run some polling questions. Please take some time. Bill, if you want to go ahead and talk through these, we'll go ahead or talk about the results. I'll go ahead and get you started with the first one. The first polling question is, are you householding your client data today? So a single choice of yes, no, or unsure. And we'll give it 30 to 45 seconds for everybody to participate.
I'm curious to see the results of these questions, because as I talk through household insights, I think it's really going to talk to this type of analysis and whether that's something you're doing today and how you're doing it. And as you discuss the strategies around growing or retaining household relationships, this is where we think the household insights solution could really help help you guys out. So would love, after we're done with this polling, and once I start going in and showing actually the live demo, at any time, please ask questions in the Q&A. And would love to answer them in real time.
The second questions are, I'm not sure if the first results are done, Jen, or if you want me to just take them all.
Yeah, they're all three are showing. So
Okay.
it looks like we're getting to. I'm gonna go ahead and end it, and we'll share results.
All right. Okay. So, Bill, take it away. You
Cool.
can comment on the results.
Yeah, just looking at the results right now, we've got 40% are householding, 30% no, and 30% unsure. The primary tools using is Excel, 64%, a little bit of Power BI, about 25% other, and 20% unsure. And then when's the last time your team strategically discussed growing or retaining household relationships? About a third in the last 3 to 6 months, 12% in the last 6 to 12 months, 16% more than a year ago, and 40% currently not performing this. So thank you for the responding so quickly to the polling. It's really interesting data.
Thank you all for participating. That's great. And so Bill's going to talk here again about Household Insights, a new offering from Optima FI. Bill, go ahead and take it away.
Great. I've got 2 or 3 quick slides, then I want to just hop into the actual production platform itself and actually show how it will work. But just as a brief overview of Household Insights and what it is, we've built a lightweight, no IT solution for banks that want enterprise-grade insights without added complexity. So what its focus is to allow you to see the complete relationship picture of your data. So you've got individual accounts, of loans, of deposits in your core or in other systems. We're able to put them all together into a single household relationship view and then compare that to our Optima FI proprietary peer performance index norm data. It's how households are acting in the marketplace. We've done this for 20 years to see certain segmentations will respond in certain ways. So we built this on the same technology where it really focused on self-service and ease of use. There's no IT setup. We don't have to do any sort of core integrations. We give the peer benchmarking. We can set it up live in under a week. And I'll only mention it here at the start is that we are at the moment offering a complimentary 90-day trial. So when you're seeing the solution, think about your institution's information in here. We can let you test drive it and actually get the insights and get the feedback on that. So if you go, Sean, to the next slide, I'll go very quickly and I'll show this live in the system, but there's really sort of 4 steps of what happens. Be able to securely upload your CSV of your standard account data that you already have. You're already doing, we saw that 40% are doing householding in Excel today. So taking that information, loading it into Household Insights. The second piece we do is automatically cleanse that data and build the households. So we've got the algorithm to normalize the data, link these accounts to true relationships, and we do that within minutes of you uploading. Once we have that, we're able to benchmark it against peers with the Peer Performance Index. We've got 14 billion non-public data points that we've been using for that household normative data, which we can then take your segmentation and your households and compare to what others, how other households are performing like that. And then finally, immediate to use ready insights. You can download this from the platform, get board management ready reports, and see those segments right away. Next slide, please, Sean. And one last piece is the segmentation that happens. Just want to sort of, if you're keeping this frame in mind as I go into the platform, there's 3 or 4 different primary sort of normative segments that we've seen. Group A is depositors, high deposit households that have more than $10,000. Group B, your active credit users, the ones that are have active loans with you. Group C, your transactors who are doing those transactional type relationships. And then at the bottom, Group D, small, limited, low balance, or inactive. What's really interesting about here is the intersection of those relationships. If you have an active credit household that also is a high deposit household, there's a great opportunity there to expand that relationship and really deepen the type of products that can be offered within there. So we're able to give that lens and that segmentation on your own data. And then Sean, if you would let me share screen here, I will hop out of the slide deck and into the platform. And then also Steve or Sean, as I'm going through, if you have any questions or want me to point something out, please stop me. And then just to confirm, you can see a dashboard that says "Hello, Bill Regala" at the top. Is that
Yes,
true?
we can.
Awesome. One last bit of coffee for the coffee talk. So real quick, this is the first thing you're seeing of Household Insights, and this is the dashboard. So this gives you context of sort of all the things that you can see and all the things that you can do. At the very top, we tie in call report data, seeing total deposit balance, cost of deposits, net interest margin, and then the delta from the previous quarter's call report. So sort of contextualizing what you'll see with your own private data, which is what you're going to see here down in the middle. Your total households that you can have month over month time series data to see your private data that you've securely uploaded that we've householded for you. You can see that immediately and then see that over time. And then finally, what we do is using that pure normative comparison can raise insights and recommendations of what to actually go do with that. And I'll show that as I dig into the system over here. But this is sort of the first piece that you sort of land on to see and Household Insights. But just to keep me honest, Bill, how easy is it actually to take my data, upload it? Let me just briefly show you quick in real time how easy that is. So I'm going to go to upload data. I'm choosing a file. I'm selecting a CSV that I have. We take an initial scan of the file. I can set the date of the month that I want to put for. I'm just using a demo account here, and this is all mocked data anyways. I've selected it, and I've got the different mappings that we have. What's really neat is we're able to identify through our algorithm based on the expected columns that we have and the columns that you've already provided us, because we've done this thousands of times over the years. We can very quickly go, oh, account ACC_open is account open date, and we can try to set that for you automatically. If for some reason we can't set it, you're able to come in here very quickly, adjust that, set whatever that happens to be, and we give you an example of what it looks like in the file. You set it one time, every subsequent file upload, it's set for you. So all you need to do is upload that file, hit validate. We confirm that it's good. You submit. Success. Data has been added. And it's now processing in the background. And this is what takes, depending on the size of your institution, we've seen it as fast as 5 minutes, go up to 20 minutes, but start the process, go grab a cup of coffee. We will email you when it's completed. You'll be able to come into the platform and see the data. What kind of data can you see, Bill? This is pretty cool. Segmentation. This is where like the heart of it is, like those circles again. I've now taken the private data from the bank and put them into consumer segments and business household segments. Within each of the consumer and business, we segment them out further. Single service households, households that only have one product type with you. Those high deposit households, ones that have $10,000 or more. Credit households, which are those households that have credit. We give you the total number of households, and that's not accounts, it's the number of households. So in the Bill Regala household, if my wife has a checking account, my daughter has a savings account, we are represented as one household, not 3 accounts. So we're able to give you that number as well as the total deposit balance for those. The opportunity indicator, there's a risk, growth opportunity, or its stability. And how do we get that? That's from the peer performance index data, that normative comparison data. So the 100 is the norm of, sort of where are you relative to your peers? And are you below in balance? Are you above in penetration? And if I move my Zoom window out of the way, let me dig into the credit household one and really show you what that means. Give you an overview of this institution, 6,400 have credit of those households. What's your penetration? The total deposit balance that they have, as well as the average balance, and how that compares to peers. We put this on a scatter plot for you that shows you where you land relative to peers in that index, but also give you the actual value. So this bank demo has 28,645 for the balance of their credit households and deposits, but by comparison, the normative peer norm is 37,461. So you're getting more credit households than peers, but the deposits that you have for those credit households are below norm for your peers. And that sort of gives you some opportunities to decide, well, how can I expand or deepen those relationships? Of these 6,400 households that have credit, 4,400 of them are single service. They only have credit with us. And of those, I also have these same households that don't have any checking products at all. If I want to get that list, take action on it, it's one click away. I click download list, I download it there, it opens up in my browser, and I can get that information and go target those households.
I got a question.
Yeah.
If I can chime in. So
Sure.
you talk about, and we see all this data from the institution, and compared to what seems like a rich index of peer data, non-public, private proprietary peer data. If we're just introducing this as a new tool, where does all that peer normative data? You said 14 billion data points. Where's that coming from?
That's coming from our growth services team that has been using this, talking to banks, credit unions for the last 20 years of running campaigns and seeing what's working and seeing the normative response to these type of segmentations, knowing that high deposit households whether it's in Chicago, whether it's in North Carolina, behave in a very similar fashion, and being able to identify what are those next best opportunities for either cross-sell opportunities or expansion opportunities. And that's where all that data comes from.
So while the tool is new, there's a ton of data from sort of a legacy infusion marketing services part of our firm that's been gathering that billions of data points for the last 20 years, and we're just now providing it back to people in this sort of format.
And that's a great way to put it. Now it's available sort of to everyone in a self-service platform to really interrogate your own data at the cadence that you want. And when I show the data uploaded, it's monthly, but you could upload data every day, update data every week. It's sort of at the choice that you would want to see the differences. You can upload it and compare to that normative data index.
Oh, we did have a question from the audience. Is the data download an API with the core, or is it a manual upload?
Great question. Today, it's a manual upload, a manual CSV. So we don't require any sort of direct core integration. So oftentimes, as we've seen with our current pilot users, they're able to run an existing report or get existing data that they're already using. And the fields that we have are, there's not a lot of required fields that we would need: the account name, the household, the address, things like that to generate the household record. That's something that we can provide. If you have a question, we can provide you with our data specification file that we have for this to operate. But there's no API required. There's no direct core integration required. We can handle it with just the direct CSV upload. Great question, though. So what's interesting, you see this for all types of segments. Of my credit households, all my households, 23% of them are credit. They only hold 5% of my deposits. And I can go to other segments too, like high deposit households. What's interesting we see across institutions are oftentimes very similar. They're about, say, 25 to 35% of our households holds, so usually north of 90, 95% of our total deposits. So this is also a great opportunity to find out these smaller number of households that hold most of our deposits, which ones don't have a primary checking account, like that transactor circle. How can I deepen that relationship? Where are the opportunities? How can we raise them up and pull that here? So we do that by segmentation. We do it down at the product level too. And everything I'm showing you has that normative peer comparison that me and Steve were talking about, all of that data that we're able to pull. From looking at money market, how do I compare to other banks and peers in terms of balance and penetration? I can very quickly drill in, see that information, identify, of those 2,700 households, 251 of them are single service, and I can quickly hop over and find that list. There's 251. Click download, and then decide if I would like to reach out to them or focus on expanding that relationship. And I did just hop over to this household list, which is a really cool tool that I do want to show off. And this is where you can really interrogate and slice and dice your own data. So I know we were talking CECL and the credit piece, and Steve, hop in here if I go sideways. But there's ways that you can try to identify, new households that maybe came in. So we've got that segmentation, credit households, got 6,400 of them. But I also want to cross apply of the new households. Now I'm down to 228. So these are my new credit households, and I can then find out, are there any of them that don't have a checking account with me? Well, there's 210. I can then download that list and try to deepen the relationship with these fresh credit customers and try to expand that relationship, maybe get some deposits as well and expand that credit relationship. And that works with both consumer and business across all the different segments, across all the deposit products and loan products that you offer. We're able to pull that in and allow you to really expand upon your data. And one last thing that I always forget now that we have in here is what makes up the household, right? I've got the Paul James household or the Dale Butler household. We've got 3 accounts. I can click into them and see that makeup. Here are his 3 accounts. He's got 2 non-interest checking accounts. He's had one since 2003 that has 1.72 million in it. He's got another one, again, fake data. It opened up in early 25 with $48 in it, and then a money market account. We're able to see that, see his information, see what segments that he's in, and really expand upon, and then have a quick way to reach out to them. If you've got multiple branches, you can select by branch. So all this stuff that I'm doing, you can do by branch or series of branches. So if you have a region, the Chicagoland region or the Northern Indiana region, I happen to be from Chicago, so you can click into those particular regions and segment those branches, find that information, and that works across all of these pages as I do it in real time, the data uploads or the data updates. So if particular branch managers, or if you want to focus on new branches or certain focuses on different branches, we take your data, make it easy to interrogate, and then make it easy to action from the platform. And I forgot to hit this button up here, is you can download the PDF view. I want to put something in a board deck. You're able to take it right from the platform with one click, take the information out, take the slide out, and be able to put that in there to tell the story. Sean, I think you were maybe going to say something. I didn't want to catch up.
I was going to add, I think one of the fascinating things about this, right, is, again, I think we're all in constant pursuit of trying to better organize, understand, utilize our data. And obviously this does that, but also it gives you that extra step of then being able to specifically target the people who you want to address, right? I mean, oftentimes we do marketing campaigns that are a little bit more of across the board, and this really gives you the opportunity to speak specifically to the customers who you want to impact or garner more wallet share from. And I think that's what most of us are trying to do. And so again, I think just having this teed up for you is just again the next evolution in better understanding and utilizing and gaining value from your data.
Great. And I'll end with the, just thinking of the poll results. If you're already doing this type of thing in Excel today, it's likely very easy to upload into Household Insights. Even if you're not doing it in Excel today, there's an easy way to just get the standard data pulled from your core and likely in a standard report. That's what we've seen today. So consider, if you'd like to see how your data would look in here, we'd love the opportunity to have you upload it as part of the pilot, so we can really, show you how sort of easy and repeatable that it's intended to be, and then learn alongside with you. And I'll be on many more of these coffee talks. There will probably at some point be Household Insights coffee talks. And if you join the pilot or have questions, I'm around, much like Steve and Sean have been on the CECL side and the call report insight side. You've got me in your corner as we roll out Household Insights.
Awesome.
So I'll stop sharing and thank you, Sean and Steve, for letting me hop on this one.
Absolutely.
Okay. I don't know. Oops. Let me. Bill, you stop sharing. Jen, you may have to give it back to me. I'm not. I don't have my share button.
Yes, I did stop sharing.
Okay. There we go. I got it. Just more rustiness from me. Okay. All right. So as Bill mentioned, we do have some free day 90 free day trials. Let's get this back up here on a bigger screen. There we go.
There's the poll right there.
Oops. Did it come?
Yep, you're
All right.
good. I see it. And the polling question is up.
Great. So while you're looking at that, again, free call report insights, request a demo. We're happy to take you through this. Household insights, request a free 90-day trial. Certainly reach out to Lauren Snow. Her email is down there at the bottom. Certainly interested and always available to discuss free trials with you. Just a reminder, we will be sending out a copy of the slide deck and a link to the recording. And we'll just make one last pause here to see if there are any questions or anything in the chat.
And then make sure you remind everyone who's going to be on next time.
Yep, and that's we'll save the big reveal. So
Yes.
Our dear, whoops, we did something come in the chat here. Let's see.
No, we're good.
Oh, okay. Our dear friend Paul Allen from Saltmarsh is going to join us in August for our next edition of Coffee Talk. So certainly please register. Paul is always a fabulous guest, brings insights
Yeah.
from the other side of the table, if you will.
Gather all your very granular, very detailed accounting questions relevant to CECL or relevant to anything community banking. And
Exactly.
Paul will give you a much more detailed and thorough and auditable answer than Sean and I probably would.
Exactly. And Paul's busy teaching at a lot of graduate schools of banking, so he does beyond just his client base interact with a large number of community bankers. So always
Absolutely.
interesting insights from Paul.
Yep.
Okay, one last look. I don't see any additional questions. Certainly, thank you all for joining us today. Thanks to Bill and Steve for letting me hop on here. Sorry for my rustiness, but we're getting back in the swing of things. Please register for the Coffee Talk in August. And Bill or Steve, any final words before we let everybody have their weekend?
No, thanks, Sean.
All right. Perfect. Well, thank you all again for joining us. Have a great weekend, and we'll look forward to talking again in August.
Thanks, everybody.
Bye now.